SIP investments are founded on the principle that equities or stocks can generate greater returns, inflation-beating returns over a longer period of time, particularly by outperforming the inflation after taxes. But we all know the general concepts. The profits are high when we buy low and sell high. The profits are more. The profits are more when the market is selling at its premium. Isn't this true that if you sell when the markets are high, you're bound to get more profits? If this is true, how does it make sense to buy into mutual fund units, continue to buy into mutual fund units when the market is at its peak? So are we not buying units at premium? Is it a sensible decision that we are taking? Or is it okay to pause your SIP for a moment, let the market fall, and then you can start your SIP back once again? Well, if you're thinking in these lines, if you're planning to stop or pause your SIP when the market is at its very high, you need to answer this question. And the question is, how do you know that this is the market peak? How can you confirm that the market will not rise further? This is a serious question. And unfortunately, no one on earth has an answer to this. No one. And that's where things starts to get confusing. Should you or should you not stop your SIP? Should you or should you not sell your holdings? Should you or should you not book your profits before the market crashes? Big questions to answer, isn't it? Investing is tricky. I always say this. Every step you take in the financial world is a challenge. And with that challenge comes the next big opportunity. This video will give you an insight, but the next one I post can bring you that next big opportunity. So like this video and subscribe to this channel right now because you don't want to miss it. Do you? SIP. We generally set up a SIP for every month to be deducted every month. So let's see a month-wise data, what it has to offer of how the market has performed in the last 24 years. That's a big history. So we go to the BSE India website and download the historical data from 2000 to 2024 and download it in an Excel format. This Excel file is a month-wise Sensex figures from 2000 to 2024. That's for the last 24 years. You can see the market dipped for more than 5% for just 45 months out of the total 296 months. That's just 15% of the time. Which means it has been on the uptrend for over 85% of its tenure in the market. It's been on the uptrend for over 85% of the time in the last 24 years. Secondly, you need to understand that the highs and the lows are part and parcel of the market. It's something which is beyond your control. And that's the very reason why you should not be giving it much of an importance. You should not worry.
तुमने सुना मैंने क्या कहा? सुना?
फिर से कहता हूं, if something is not in your control, you shouldn't worry. Why worry? Wonderful philosophy, isn't it? ये philosophy पसंद नहीं आया ना? See this. It's not mine.
Do you have a problem in life? No? Then why worry? Do you have a problem in life? Yes? Can you do something about it? Yes? Then why worry? Do you have a problem in life? Yes? Can you do something about it? No? Then why worry? Isn't it? Isn't it? Why worry?
And now, probably, you will love this philosophy, don't you? So now, whether the market is at its peak or is it at its lowest low, why worry? Isn't it? A report from ET Money says for investments over 7 years up to 20 years, these are the approximate returns from the market for investments in Nifty 50. From the upfront view of what we see in this table, it looks like SIP investment is always better than lump sum, at least up until 15-16 years, then it gives way to lump sum investing. But what gets neglected here is the comparison it draws, the comparison between the XIRR and the CAGR numbers, and that makes all the difference. The difference looks a sniffy healthy in percentage points in the table. But if you compare its actual value in real terms, it might be huge. It might be really, really big. So for the same time frame, if you see the extra corpus created with lump sum over SIP on a monthly SIP amount of 5,000 in Nifty 50 TRI for 7 years, 10 years, 15 and 20 years, it can give you a massive difference in the final corpus. Clearly, lump sum investing is a winner for long term, for very, very long term. Well, if that's so, why me and other influencers, everyone insists on a SIP? Why do we do so? The reason is, it's all here. It's all your psychology. This psychology draws the benefits. It's not the mathematics, not the numbers. It's what you do, how you think, how you perceive that draws the benefit. So when you have money in your account, requirements pop up. They just pop up like weeds. They grow like anything. Unwanted needs keep poking your back. And when that starts happening, the first place you see is your retirement account, your investment account. That's where your eye goes. You have the money. This is where the majority of the investor with weak nerve, they break down. They completely break down. When you do a lump sum, it's an impulsive, one-time investing strategy. You have the money, you invest once, it's done. Then you forget. You do not build the nerve. It's just like getting into a ring with Mike Tyson. It's just like getting into a ring with Muhammad Ali. They might give you some slow punches. You might take the hit once in your life, or maybe once a month, once a year. You can say, I have faced him, I have faced this person. But that does not build your stamina. That does not build your tolerance towards getting the hit. You might face them and then you disappear from the ring forever. You haven't built the stamina. It's all about continuously taking the hit and keep moving forward. Remember?
Get hit. It's about how hard you can get hit and keep moving forward. How much you can take and keep moving forward.
That's how a winner is done. SIP creates that tenacity. SIP creates that habit. SIP allows you to take the hit and keep moving forward. SIP allows you to be in the market regularly, every month, whether it's falling, whether it's rising. SIP gives you the taste of the market all throughout the journey. That's how you take the hit of the market and keep moving forward. It gives you the pain of seeing regular investments going out of your account. the pain of your money going out of your account every month, it actually restrains an investor to make an unwanted, unfilthy, unwanted expenditure even when the time comes. This effect builds the tenacity in an investor, and it refrains him from taking or making an unnecessary withdrawal. And as a result of this difference, many a times, people who intend to make a lump sum investment and keep it there for a very long period of time doesn't actually keep the money for that long. The only and only reason is he or she has not developed the nerve. So, what should a SIP investor do? When the market hits a record high, two scenarios unfold in front of you. Either the upward trend will continue or a correction is coming up in near future. See, when the market continues its ascent based on robust company earnings, favorable economic conditions, or maybe heightened investor emotions, it can evoke excitement amongst investors. However, it's crucial to understand that all upward trends may not always be sustainable. Despite all of this, this should not discourage anyone to stop their SIP investments. What if the market continues to rise beyond the point where you thought it's the highest high? You would miss out on the opportunities, don't you? Now, what if the market really tanks down? That gives you the opportunity to buy more at a very cheap rate. So, it's a sort of gambling to predict whether the market is going to go up or whether the market is going to go down. If you're waiting to buy the units at a lower low and the market shoots up, you're losing out. And if you're waiting, thinking that the market is very high and I'll buy low, just think the market was on a rally for the next 5 years before the 2008 market crash. What would you do? You would wait for 5 years? So do not wait for the gamble. It is very difficult to predict the market situation. It's very difficult to predict where it's going to go. And also, at the same time, it does not build up the nerve that is required to make huge profits, to make huge returns. Go with the SIP, take advantage of the rupee cost averaging, and smoothen out your purchase in the market. This strategy can potentially enhance your returns over a very, very long period of time. To top on this strategy, the nerve that you would build up while doing this, the hit that you're going to take from the market every month, regularly, persistently, for a long period of time, like 15, 20 years, is going to make you the person fit for this market. It's going to be the major contributor for your massive, massive returns. So not just this video, but the videos here listed in this playlist, in these playlists here, can tell you what you should be doing next. Go ahead, click on it right now. As of this video, adios.